Happy New Year. Welcome to the Ellsworth Advisors December update for 2021. I'm Kelly Keenan. This is Cameron Mealy. And today we're going to discuss what happened throughout the course of the year from an economic standpoint. Also discuss our portfolios and give you a little insight into what we're thinking for 2022. Cameron, why don't you kick us off with some economic news?
Thank you, Kelly. Happy New Year to everybody out there. This is the time of year where all the major firms come out with their 2022 economic forecasts. So I've been digesting a lot of them over the last couple of weeks and want to talk about a couple of themes. You know, really the overarching themes we're seeing when it comes to forecasts for 2022 is continued recovery from COVID lows, but still pressure from supply chain disruptions, input shortages, and labor shortages. Also seeing strong consumer demand and continued government support. Government's expecting to still be accommodative even in 2022, even as they start to pull back a little bit. And then also noted in all the reports is inflation. Inflation definitely looks like it is not transitory. It's here to stay, and a lot of economists believe that this could be the biggest issue that could impact 2022 is what we see on the inflation front. I found a quote. This is from JP Morgan. This is from their 2022 assessment, and I thought this really kind of summed up what we've seen across all of these forecasts. So this is a quote from JP Morgan. Our view is that 2022 will be the year of a full global recovery, an end of the global pandemic, and a return to normal conditions we had prior to COVID-19 outbreak. We believe this will produce a strong cyclical recovery, a return of global mobility, and strong growth in consumer and corporate spending. Within the backdrop of still easy monetary policy, for this reason, we remain positive on equities, commodities, and emerging markets, and negative on bonds. So that's kind of an overarching theme from JP Morgan. Obviously, they've got rose-colored glasses on when it does come to COVID-19. This report was published during Omicron, so obviously the full impact of Omicron has been factored in here. Now, what we are seeing, which is very positive, is it does seem that Omicron is a much more contagious variant of COVID, but it also does appear that it is a much less severe variant of COVID, especially if you're vaccinated. So hopefully, we are going to see the end of COVID. It's not going to dominate the headlines. It's not going to move markets. It's just going to become a backdrop as people continue to get vaccinated. We continue to work on health regimens for treating it. We continue to move forward. There's
a lot packed in there. I think the inflation, there's a reality. We are in a higher inflationary environment. The last, what's it been, 15, 20 years, we've been seeing maybe 1.5%, 2% inflation or lower. It's been pretty benign. Mm-hmm. I've read some good studies where, moving forward, we could, the longer term trend could be in that 3 to 5% range. That's just, stays at that level for quite a while. So that's going to be a little bit of shift in what to expect moving forward. And really that also drives interest rates. So, the Fed obviously needs to become less accommodative. Mm-hmm. Rates are probably going to go up, at least on the short-term rates. And inflation will, like I said, will probably be with us for a while at a higher level. Does that mean it's going to be devastating? No, but it's just a new factor that is a reality moving forward. COVID will be with us. I don't agree that everything's going to go back just like it was back in 2019. I think the economy is going to grow, and we're definitely in more recovery, but things are definitely going to be different. The same playbook that worked in 17, 18, 19, I don't think it's going to work so much going forward. But, that's part of, things evolve. There's no, we will not go back exactly the way we were, that's for sure.
So let's talk about growth, because obviously GDP is the measure of the growth of the U.S. economy, global economies. So the Conference Board, which is a nonprofit research organization, a global nonprofit research organization, they came out with their projections for GDP through 2031. This paints the picture. U.S. GDP between 2000 and 2009 grew at an average of 1.9% per year. Between 2010 and 2019, U.S. GDP grew at 2.2%, an average 2.2%. Obviously, in 2020, we saw a negative 3.4% GDP. In 2021, the current estimate is for 5.7% for the full year. The Conference Board's projecting for the U.S. the GDP will grow 3.8% in 2022 and 3% in 2023. with an average growth in 2022 to 2026 of 2.1% and 2027 to 2031 of 1.8%. Over that same period, they're projecting global GDP to grow at about 2.5%. So really, in the opinion of the Conference Board and their experts, 2022 and 2023 are going to continue to be very strong economic growth years for the U.S. in terms of GDP. Now, how that translates to performance in the market or to individual companies will vary.
That's a different story.
That
absolutely.
is a different story.
Yeah, I mean, I definitely, 22 is pretty visible. I think that's going to happen. 23, we should still be seeing recovery mode from COVID because we're going to have fits and starts this year. Let's call it like it is. You get normalization of the supply chain. So I can buy that. Cam, you make a great point about the stock market. The stock market, because we're probably looking at a different type of inflationary or interest rate environment, what's going to work in the stock market could be a lot different than what has been working. So that's where what we do know in an inflationary environment, we want companies that are making money now, cash flowing now. We want productive assets, which means once again, companies that are growing, making money, and then also commodities. Those are productive assets. Real estate is another area that we're going to have exposure to kind of counterbalance what's going on in the inflationary environment. Longer term bonds, they're going to feel the pain. I think the U.S. Treasuries are down over 3% last year, or in general, Treasuries were down 3%. I think the 10-year was down 3%. The U.S. aggregate bond index was down 1.5%. International bonds were down like 4.7%. So I think there's more of that to come. We need some bonds in the portfolio. We stay short with those to eliminate that interest rate risk. We need some ballast in there because for relying on equities for growth, what comes with that growth is a lot of ups and downs. And I think volatility is going to be the name of the game in 2022.
Bonds are where you protect the cash.
Right.
Bonds are where you protect the liquidity that you're going to need over the short term.
I think the market will make money from the beginning of the year to the end of the year. It'll be up is my thought process, but along the way it's going to be all over the board.
So that's interesting. You said you believe the market's going to be up, but it's going to be all over the board. One of the things I thought today, since it is the beginning of the year, a gentleman's bet.
Oh.
The S&P 500 at the end of the year. What is the S&P? Is it going to be up? Is it going to be down? How much? I've got my number. What's your number?
I'd say it's going to be up between 4 and 8%.
4 and 8%. Kelly, unfortunately, you're wrong. It's going to be up 12%.
Okay.
According to
there you go.
My number cruncher right here. So you heard it right here. Kelly's at 4 or 8%. I'm at 12%. We'll see at the end of the year. We'll rewind this tape.
It's at 4.28, not 4.8.
I know it's at 4. We'll see at the end of the year.
Pretty precise.
We'll rewind the tape, and we'll see who's a better prognosticator.
That's fine.
Even though we were both just throwing up numbers
at
the wall.
Yes. Absolutely, absolutely.
Now, one last thing before we get into the portfolios. Underscoring the growth. You look at the most recent unemployment number for November. It was 3.9%. That's down from 6.4% a year ago. So obviously, there's been a dramatic increase in the employment landscape. But if you look, I was reading the Wall Street Journal today, this morning. They said that prior to the holidays, there were still, now this is not just seasonal, this is total, there were 12 million unfilled jobs in the U.S.
Right.
Which is unbelievable to think about. To think about how productive this economy could be if we could find the labor inputs for all of those jobs, or at least some of them.
Exactly. It's a unique dynamic. We see it with our business owners. I think you have a lot of people leave the workforce. When will they come back, if they'll come back? Obviously, you have the boomer generation continues to age and retire more. So I think COVID may have opened the eyes of people who are close to retiring, finding out, from a personal finance standpoint, what really is important. And with a strong market, okay, people find out they can maybe live on less, or they get a real good idea of
strong market.
what they need to live on. You have a strong market, so their balances grow. All of a sudden, the
their home values are up.
Yeah, the 63-year-old, 64-year-old, 65-year-old that was planning on working another 5 years. Wait a second, my advisor says I have enough money to retire now. Why not? I'm going to retire, collect Social Security, and start doing stuff I enjoy.
Yeah.
I think there's a lot of that out there because remember, the boomers is a big generation, and it is starting to wind down where more and more are being retired. But that's an interesting dynamic. So I think The other thing that's happening, I think the economy is going to be a little bit more, labor is going to have a lot more power than in the last 20, 30 years.
Absolutely.
Capital had all the power. Now you're going to see labor is going to be a lot more influential and hold, a little more weight, which once again kind of changes the dynamics of what we're looking for in the companies we're investing in.
Absolutely.
Speaking of which, let's talk about the numbers. What happened with investments this year? For December, Dow was up 5.38%. The S&P was up 4.36%. NASDAQ up slightly, 0.69. Small cap Russell 2000 up 2.11. Internationally, the developed world, the EAFE up 5.05. Emerging markets up 1.62. For the year, this is where the numbers look really good. The Dow up 18.73%. S&P great year at 26.89%. The NASDAQ up 21%. Small caps, the Russell 2000 up 13.69. International definitely lagged, up 8.78. Emerging markets down 4.59. I know JP Morgan likes emerging markets going into this year. I'm not as excited about them. When the U.S. sneezes, emerging markets definitely catch a cold, if not worse. So not as high on the international scene at this point in time. From a portfolio standpoint, our best portfolio this year was dividend yield. Our most conservative stock portfolio for December is up 7%. Year to date up 28%. In December, Cisco up 15.55, Paychex up 14, British American Tobacco up 13.4. Kind of lagged throughout the year. We finally caught a bit at the end of the year. The big laggard in December was Blackstone, down 8.53. So gave some back in December, but our biggest gainer for the year was Blackstone at up 108%, maybe a little profit taking at the end of December, possibly. Pfizer up 66 for the year, Paychex up 50, Eaton up 48. Once again, Cisco up 45. Laggards for the year, Verizon, big disappointment, down 7.5%, Merck down 3%. I think Verizon's been popping the last couple of days, so we'll see what happens there. Growth with income portfolio, December up 5.75%. Year to date, 15%. Once again, it's a balanced portfolio. We're about 55% stock exposure, so we'll take 15% there. Gainers in December, CVS bumped up 16%, Cisco up 15.5, Apple up 11.5, Lennar up 10.6, pretty strong numbers there. Laggers in December, once again, probably another profit taking. Nvidia down 10%, but year to date, Nvidia was up 125 even after that 10% pullback. Once again, emerging markets down 3% in December. Big gainers for the year, once again, Nvidia up 125, Lennar up 54, Cisco up 46, Apple up 35. So pretty strong numbers out of those stocks. Big laggers, Disney has been the drag. Obviously, being the parks being a big part of their business has hurt them. The movie business has changed a little bit. I think the box office probably hurt them too. So we'll see what happens with Disney, kind of reassessing what we're doing there. Emerging markets, our fund there is down 13%. Once again, Verizon down 7.5%. Price potential, decent year for December, up 8%. Nice little roll there. Year to date up 26, so just almost in line with the S&P 500, better than the Dow. Decent year there. Big gainers in December. Edwards Lifesciences up 21. Black Knight up 16. Stryker up 13. Humana up 11. Really in laggards. The only thing that was down in December, well, it wasn't even down. Comcast was only up 0.7, so no losers in December in price potential. Year to date, Edwards Lifesciences up 42, Allstate up 10%. Let's see. Other than that, that's all that's left in their portfolio. Other than that, we've been pretty much rotated through the portfolio. A lot of turnover. We've had a lot of gains along the way, but basically what's left over in there, those are the big gainers at this point. Small cap portfolio, December up 2.75%. Year to date up 23 versus the Russell up 13. I think we've kind of killed in small caps. Pretty happy with that. December gainers, Clearfield up 30%. One Water Marine up 19, Nova Measuring up 14. Mantech up 11, Laggards, Joint Corp down 18, Allied Motion down 7.5, Triumph Bank up 6.5. Down 6.5. So not a lot of big losers last month. Year to date, at Core up 170%, Perficient up 171, Triumph Bank 145, Nova Corp up 107%. Advanced Motion Technologies up 63, and once again, we basically weeded out all our losers. So, pretty good year for the portfolios. In general, I think they've done as expected, and we're going to kind of stick with the strategies. The methodology behind the portfolios, we're going to continue to use those. How we have them weighted in our portfolios, that's going to kind of be a driving position. Like I said, we're going to be adding a little bit more real estate exposure this year. We still hold on to the commodity exposures. Gold, pretty lackluster last year, probably down 5-6% for the year. Our commodity piece was up close to 30%. So that, we kind of 20 gold work, commodities were flat. Last year, gold kind of flattish and slightly negative commodities worked. Kind of sticking with that same playbook this year. Other than that,
other than that is, given that it is the beginning of a new year, a lot of times people sit down and they think about their budgets, they think about last year, think about new milestones. So as things change, as you see stuff coming over the horizon, as always, please reach out to us. Let us know what's changing in your lifestyle. We'll obviously be reaching out to all of our clients as we do to sit down, do performance reviews, catch up. But, again, we can be as proactive as possible, but as soon as you see those changes coming down the pike, let us know. And, lastly, remember that Kelly Keenan has little conviction and did 4 to 8% in the S&P 500, where I went with a solid 12%. Put my stake in the ground where you were just kind of all over the place. I'm surprised you didn't say 4 to 30%, just to kind of cover all the bases. But we'll see what happens at the end of the year. 30 could be a
stretch. We'll see.
See what happens at the end of the year. Happy New Year, everybody. Please feel free to give us a call with any questions, and thank you always for your trust.
Thank you, and have a great year.